All right. Good morning, everybody. It is FOMC day, the day we've been waiting for, but really the day that's already priced in. Got to get through it, see what Powell's forward guidance is, if there is any. It's very likely we're going to continue to remain in a hurry up and wait and see mode is what it would be, not hurry up and wait and see. The the lack of forward guidance continues to weigh on everything, and that's just the way it is. Years of trading where we will have these fantastic Goldilocks scenarios, and we're like on autopilot. It's just good times and easy trading. As much as anything can be considered easy trading, but we're not in those times. We're in more perilous, difficult times with lack of data, government shutdowns, transitioning Fed members, lack of autopilot and forward guidance within the Fed. There's so many things that make this a more difficult time to be trading. And I'm certainly not saying sit out and don't trade, but I see so many people every day blindly ignoring the additional risk that CPI, PPI, non-farm payrolls, FOMC brings, and just continues to sit there with their hand out saying, give me another trade. Give me another trade. There's got to be something else we can trade today. Give me another trade. My goodness. If they survive to the end of the year, I'll be surprised against all the rhetoric and the talk and the warnings and the pleading to just sit back, wait, look for a less riskier situation. They continued to pile in. I'll just say it again. Know what you own. Be careful with your risk. Understand that these are not Goldilocks times. We're sideways this morning still. We've been sideways now all week. The hurry up and wait that I called on Monday is still in effect. It's the same hurry up and wait that I called last week. And it's very rare for such a situation to last more than the 2.5 days, 3 days that we have seen in the past. So when we come out of this sideways hurry up and wait mode, the potential move is radical. The longer we go sideways, there's an old market phrase that says the wider the base, the higher in space. And that's great if we're at the lows building a base, but we're not at the lows building a base. So the other way to read that comment is the wider the sideways action, the bigger the move when we finally come out of that sideways action. If it was a base, it would be higher. And if it was a topping pattern, then it would be lower. So we'll see how it all turns out. But it doesn't hurt to shop around for some far out of the money, very cheap lottos. We're talking, things that have a 3 to 5 delta and cost you literally pennies to put on, right? Options risk of 1 penny, that's $1. You can't get coffee at McDonald's for $1. So, what's the stress of picking up a couple of options on something? And it doesn't have to be SPY and the Qs. Anything that matches the SPY and the Qs. So Spot Gamma likes to use SMH as a proxy. The SMH options can be cheaper than SPY and the Qs, maybe have a better implied vol and just maybe a better vehicle. But I mean, it could be anything. You could use any of the Mag 7 or some of the sector ETFs. I like the XL series, the spiders. Shop around and see if you can find different ones. And it doesn't have to be negative. You could, get some far out of the money calls if you want to. Something, again, that's really cheap. Look at the tail risk and just see which side's cheaper, left side tail risk or right side tail risk. And if you don't understand what I'm saying, just ask. So we're flat. We're waiting on data. Everybody seems pretty confident that we're going to get the rate cut. What we don't know is the forward guidance. The Fed had anticipated 1 cut next year. The market has 3 cuts priced into next year. If they're going to begin unwinding those 3 rate cuts to get back into line with what the Fed has said, then we should see some downside pressure, right? Because we saw what happened when they unwound 1 rate cut. You can see how the market has moved since mid-October, for an example. The move down, the move back up, that was all because of 1 rate cut. If they need to unwind 2 rate cuts, what's that going to look like? We're going to get some old employment cost index data, and then we've got FOMC. I don't think there's anybody out there today who doesn't know that today's FOMC day. Even the newest new people, I believe, would have caught on by now. We've been shouting it from the rooftops. We're also going to get oil inventories today. As usual, this is our time to see what the strategic petroleum reserves are at and gauge how the collar is holding. A hawkish cut is what they're considering. I don't think we have anything on the White House either for today. Doesn't hurt to check. Yeah, no, low risk. A roundtable discussion, that's pretty much it. They're going to meet up in the Roosevelt room. There's a lot of macro data to suggest that TSMC globally is a forward-looking gauge on the market dynamics. So if we start to see weakness in TSMC, it's a forewarning of broader market weakness. It's down 6.5% month over month, but it's still up 24.5% year over year. So we are seeing a little bit of a slowdown. I've got an old report that was wrote up on how and why TSMC can be used for that sort of macro backdrop. I picked it up from these guys here, Macro Micro. Love these guys. They got all kinds of charts that dial in and hone in on that TSMC concept. So when you see any headlines that are focused on TSMC, just at least catch the headline, if not read the article, see what they are talking about. It's not something that happens the next day, right? Those macro concepts take time to come in, but it could be next quarter, looking ahead into what's coming down the road. We've already got Yesterday's 111 already taken care of, and we've bounced off of the 10-day moving average this morning. So it doesn't owe us any move since we've already got the move done and out of the way. We're still hanging out at the volatility trigger. We are above the 3-week moving average, and we have the 20-day below. Then zero gamma, and a long ways off that put wall. The put and call wall still has not moved. I continue to double check that every day because would have expected it to move by now. But nope, still hasn't moved. And that means it's not going to until OPEX. OPEX is always the third Friday of the month. So you can just, count that on a calendar. We are this close to OPEX. It's very likely that the call wall won't move, or the call and put wall won't move unless we actually hit one of them. Considering how long we've been sideways and building out this range. Funny enough, we could hit both. Wouldn't that be some shenanigans? So you can see on the daily that we hit the blue line. That's the 10-day. Of course, that's the same 10-day here, just shown on the intraday chart. We are set up for a potential surge signal. A surge signal would be if we cross the 10 and we get deep enough under the 10 that we drag the 3 period with us and it crosses underneath the 10. Once we have price and the 3 crossed under the 10, then it's a bear surge signal. If we were going the other way around, we'd get price crossing through the 3 and the 10, and then the 3 would cross through the 10 to the upside, and that would be a bull surge signal. That's what we had on that reversal back here in mid to late November, was a bull surge signal. Of course, it hasn't happened yet. We can see the setup is forming, but that doesn't mean it's got to follow through. Even though we are in hurry up and wait mode and there seems to be a lack of market participation, there's still a lot of trading going on. 69,000 again in the overnight. It's some decent flow for a hurry up and wait scenario. We got moves through the kill zone. Actually, that came in after the kill zone. Came in late again. That's the second day in a row we had one of those 5 o'clock movers. We are still maintaining underneath VWAP, so we could see some reciprocation as we get closer to the open. Whatever we got below, we would anticipate to get above. And that can put us back up to yesterday's high. So we have the opportunity for 111 again. We got our 111 on the downside, but why not get one on the other side? It's not being greedy. It's just being fair. All right, these are the ADR levels for today. At least until 2 o'clock, we're not expecting to hit either side. Should be just another day of hurry up and wait, anticipating that nothing is going on until we finally get to the FOMC meeting. We are still hanging out at this low from Monday, so we could get a 111 off of Monday's low. And just take the whole day. Don't even bother with the RTH part. So measure Monday from the lowest low to the highest high. You can do that right off of the daily chart and use that for the breakdown piece. If we get a breakdown below 68.32 cog line, really it's 68.35, but I'd rather focus on the cog. If we break that, which is Monday's low, then we've got 28 and 21. 21 would be the OCC. Opposite candle color, OCC. There really isn't a whole lot to go through on an FOMC day because we don't have any expectations of anything until we get the data. Today's floor pivot is lower than yesterday's. That's bearish. Price opened underneath it. That's also bearish. And we've hit the pivot already, so we don't have an MDP. And even after hitting it, we stayed underneath it, and that is also bearish. It doesn't owe us anything, and we are underneath the weekly floor pivot, which puts us in a broader market bearish bias. The S&R lines for today, they're a little tighter than the ADR lines because they are more responsive to the short-term market behavior. So they're closer to us, and we already hit S1. There's a market logic that says S1, R2. R1 is right here. S1 is right here. R2 is up here. We're looking at an inside day breakout, getting above yesterday's high, getting beyond the 111 and the 1236. It looks like if we was to measure yesterday's high to yesterday's low and then project that up, it might be around 50% because that seems higher than the 111 and the 1236. I would say it looks closer to 1.5, right? So that'd be 50% of the entire measured move here. Looks close anyways. So going S1 to R2 is straight out of the textbooks. It doesn't mean that it owes us that, but the fact that we bounced on S1 and we held, we didn't break through it and continue to go lower than that, does imply that we can get an R2. There is a little bit of an issue with market direction. The indicator this morning is implying that downward is more likely than upward. How do we know that? The distance between the floor pivot and S1 is greater than the distance between the floor pivot and R1. If we just put a box between those two or measure those two, that's the R box, and this is the S box. You can see that the S box is much bigger. Okay? So S1 is a much bigger range than R1. That's the indicator implying that the move downward is more likely than the move upward. So getting a S1 bounce into R2 is technically possible, but not when we add the idea of it being, is it likely? Not likely because of these boxes. Boxes are saying it's not likely, but it is possible. So if it's not likely, what is more likely? That we break S1, which is basically Monday's low, and we get into 68.25, which would be the 1236 of Monday's low, and then we get our OCC, flip it around, and come back in again. Yep, I like that. That sounds more plausible. All right, on the week, this distribution looks a lot like last week's distribution. We're filling out nicely. We're getting into the shallow part of the zone. So if we lose this, there's nothing here, right? It gets shallower and shallower. No real footprint down there to help us out. Now, if we look back just a little bit farther, we can see that 68.20 or the value area low of last week is kind of that last hurrah or the line in the sand that below that we could go for the next 50. So 67.50 if we break underneath 68, I'd say 68.32 cog line, but it'd be 68.20 for that value area low. Otherwise, we're leaving a lot of footprints behind over our head. It's going to make it harder to work our way back up if we did want to work our way back up. We keep testing that liquidity pool at 68.40. 68.40 is an old school cog line that we don't use anymore, mainly because I don't want to spend the 3 months it takes to validate one cog line. That would only be the 68.40. We'd have to evaluate 67.40 and then 66.40, and yeah, it's a lot of work. So it's an old cog line, but there's a lot of work at that spot. We continue to test liquidity at that level. Watch the tape when we get down there, see how the tape responds, see if it's increasing the speed, the pace of the tape, the size of the orders. Are they doing a lot of pulling and stacking at that level? Does the bid ask increase when we're sitting in that area? See if there's anything still there. Because if there's not, if we've taken it out, then the next time we go down into that level, we're just going to cut right through it and keep on going. $10-day, 30-minute volume profile and TPO. We've got a really narrow value area for a 10-day window. And everything we've got is stacked across the top here. By tomorrow afternoon, we should be this narrow. And if we don't get into these lows by the end of the week, then this will be our new range. 100 points from 6,900 to 6,800. All we got to do is break the range, but it's been winding up tighter and tighter and tighter. And the longer we keep this range, the more significant the structure is that we build out above and below. In fact, this could be our bowling lane until we get out of FOMC, OPEX. Because of the way that they would hedge their trades, and longs and shorts would not know they're wrong as long as we stay inside this box. This could be our graveyard and hang out here all the way to OPEX. Now that doesn't mean that we can't challenge the edges, break out and get a 111 or a 1236 above and below this 100 point range. The idea would be that we stay inside the range until after OPEX. So unless we get something from Powell that radically alters the landscape, that's going to be the base case argument at this point. We got a new VPOC from yesterday. I'm not going to zoom in and get it down to the tick. Close enough is close enough for me. But you do you. Looks like it can go down a point. We're just carrying forward the spot with the highest amount of volume from yesterday, right? The point of control. It's a VPOC because it hasn't been hit yet. And we can carry that forward day after day after day until it finally does get hit, right? Like there was one from back here They got hit yesterday, so I took it off. But you can see how it got tested and then tested again and then tested again, and finally we cut down through it. So we would carry these levels forward until they're hit. The textbooks will tell you to carry them forward at least one day, every day. Right? Every day you would carry the value area high and low and the point of control into the next day's trading session. I've already got enough pivots. I don't need to do that. But you know, if you're thinking, gosh, it sure would be nice to have more pivot points. Well, there you go. You got 3 more. I don't like to call these support or resistance because that puts bias into them. Instead, I like to consider that they are truthfully stated where the greatest amount of trading volume took place on that particular day. And then we can make, you know, a little bit of an assumption that should we return to that spot, there's likely to be increased trading again, either because of traders' remorse or from people who missed the opportunity who now want to get in at that level. We are IX10 at this point. Sounds really fancy, but if you haven't heard the phrase before, it just means that we are inside day and that it has lasted for more than one day. So we can see that Monday's range, Tuesday we stayed inside of Monday's range, and now Wednesday we're still inside of Monday's range. If we get stuck inside of a really big bar, like this blue bar right here, and we were stuck inside of it for 2.5 weeks, who cares? It's completely worthless. It has no value from an IX10 perspective, no insight of anything like that. No compressions or expectations of violence, nothing. But when we're in a really narrow range, things change. We are now in our 3, narrow range 3. There's some really popular numbers when it comes to like NR7 and the outcome of those NR ranges. If you haven't heard that phrase before, check it out. Jump on YouTube, look for NR narrow range candle patterns, setups, counting. It's worth picking up. Now, I don't trade that system, right? As with a lot of systems that I've learned, I don't trade it, but I do use it in the context of analysis and a little bit of insight. We're not overbought. We're not overextended. We haven't moved too far too fast. And that shouldn't be a surprise because we haven't done anything all week. And we are at the 10-day, which we already knew because we talked about bouncing off of it this morning. So we could break out or break down in front of FOMC, but why would we? It's going to have to be something really negative to make that happen. Otherwise, there's no reason to anticipate that we do anything other than hurry up and wait. Now, we got the VIX back above 17. Anywhere above 15 says that the S&P is in a little bit of a pullback. Right? We got the VIX chart. What did you? I don't want that. Just VIX. Just VIX. There you go. So you can see we are above 15, which means we're in the quote just a pullback area, and we are less than 20, so we are still just in the quote just a pullback area. If we get above 20, then we're into a correction or a deeper pullback. So that's what we want to continue to focus on is where's the VIX, what's it doing? And if we start to get a breakout in the VIX, then we want to pay particular attention to what's going on. We're certainly not in any sort of backwardation. We're still in contango. For those of you who know, you know. Everything else is good. But it is up a bit. Looking at things that are down, pot stocks are down with nat gas, gold miners, Bitcoin, building materials, and solar. And things that are up, the VIX leads the way at 3%. Pot stocks, there must be a little discrepancy with pot stocks. Yeah, we got some that are down and some that are up. So some pot stocks are up. Ag is up. And then silver. So gold miners are down, but silver is up. It is such a broken market out there this morning. Crude is up, and the China group is working on it. They're up more than a quarter, but less than our benchmark of 0.5%. It is so broken out there this morning, guys. Really just stand aside. Don't get in the way. I heard this little quip once about the light at the end of the tunnel. That light just might really be a freight train coming at you to run you to hell over, right? It doesn't mean you're actually reaching the end of the tunnel and that there's light on the other side. Today's not the day, all right? So make it through FOMC. Then we got a better idea on the other side of it for expectations and which direction we could look, right? Growth versus value, commodities, wherever we want to look after that, we'd have a much more clarity. So we just have to get there first. This is my market scan, just checking the indexes, how many are up 0.5% versus how many are down. And there's nothing, right? The S&P, 8 names are up 0.5%. The mouse is acting a little weird. And in the NASDAQ, 7 names are up 0.5%. Looking at the names that are down, S&P down, 5 names are down 0.5%. And 11 names in the NASDAQ are down 0.5%. So nothing, right? We got nothing, and we need to let things play out. So approach with caution, watch the clock, be careful, be safe. I'll see y'all tomorrow.